And a good top of the hour to you folks. Thank you for being with us here on our third and final day of the VID5 conference, brought to you by our sponsors at Laurentian Bank Securities. I'm Mark Johnston, your host, and I have the great pleasure at the top of this hour to move us over to London, where we have a fantastic guest in Fred Bell, the CEO of Elemental Royalties. Fred, thank you for joining us today.
Mark, delighted to be here. Thank you.
Very good. I'm going to step to the side and hand you the reins, and we'll see you for the question and answer period.
Perfect. Well, welcome everyone to the presentation on Elemental Royalties. This is our forward-looking disclaimer that we'll be making statements in the presentation looking to the future. I think straight from the outset, the key differentiator in Elemental Royalties is a really strong cash flow profile with excellent exploration upside. And I think that is the differentiator for us. And you can see it here, both in terms of our guidance for 2021, $6.8 million US revenue, but really importantly, going into 2022, and we'll have final numbers when our operators announce, but somewhere in the region of 10 to 11 million US revenue next year. So really material growth coming into next year. And I think crucially, that is de-risked growth. It is from a mine that came into commercial production in Australia in October, and from an existing royalty on Equinox's Mercedes mine that starts paying us from July next year. So these are not development projects. These are existing mines operating that start paying us royalties going into next year, and really material increase in revenue growth. And I think the reason that's so important in the royalty space is that there is exploration upside coming at some of these assets. We have already seen it across our portfolio. We will see it more going forwards. But what you really want is you want a strong base of diversified revenue from the outset. And that is what Elemental gives you. And I think gives you almost uniquely for a company sub 500 million market cap. Importantly, team with a really proven track record. We started this company privately in 2017 at a 27-cent share price. We did a number of rounds over 3 years privately, built it up, listed it in the summer of 2020. Management and board still have 16% of the company. We have participated in all the fundraisings as well as buying on the market recently. So I think that's really important for management and board to be aligned with shareholders. And we joined Discovery Group in Canada when we listed last year. So John Robbins and Jim Patterson, and that's a really good group of, I think, very successful people and companies. And so very helpful for us being part of that. Last 2 points on the portfolio then, it's just that focus on producing royalties. We are about 80% of our NAV is over producing assets. So again, very unusual, I think, to see that in a smaller royalty company. And these are all uncapped with no limits on them in terms of production. And I think that's really important as well. Here to provide you some context, you can see in the middle of 2020, we listed, it was at a 130 share price. Since then, we've traded anywhere from, broadly speaking, 180 to about 130. A couple of the key transactions here. I think what's really important to see is the quality of the assets. And the fact again that these are mostly producing royalties. So I think for the royalty space, we have done the hardest part first. We can go out there and we can buy exploration development royalties. We haven't. We've really focused on building that foundation of diversified revenue, so that I think for the first time coming into 2022, we will have meaningful free cash flow that we can use to deploy into new acquisitions. And that is, I think, unlike any of our peers. If you look at this slide, that is it's up till 2020. Those are the audited numbers every year that we have announced in terms of revenue. So you can see that we've really managed to increase the revenue every year at the same time as growing the share price. Going into 2022, I think looking at 10 to 11 million at current gold prices, and that should be updated in the start of January with our official guidance for the year. Crucially, a couple of highlights I would point out here. These royalties are all zero cost to Elemental. So we're not paying any part of the gold price. We get a 1%, 2%, whatever it is, directly on the top line revenue on these assets. And our biggest royalty just came into production, commercial production. It hit at the end of September, start of October. So going forwards, that will be the biggest contributor. And that's a large part of driving our revenues higher going into the next 12 months. I think really excitingly, we're starting to see from some of the operators exploration upside. And I think we'll come on to that as we go through the presentation. But there are a few assets where there's really material resource growth potential. And that's key, because I think that is where you get outperformance in a royalty company, is seeing that resource grow over time. And we participate in it, but at no cost to the company and no cost to our shareholders. So who are we and what's the team? I think always a key question. There's a board here that is a really good breadth of experience across both the technical side, particularly John and Peter. And John's founder of Discovery Group, a number of successful companies in Canada. Peter is one of the founding directors, along with myself and Richard. And Peter was Independence Group in Australia and a number of companies, geophysicist by background. We have as well on the board Simon Collins, who is a representative from South 32, and Martin Chiren, who is CEO of FPX Nickel. So I think a really good blend of skill sets there. And in terms of the management team, I think the key part of the team is based in London, as Mark said. And I think we have that blend of youth, energy, drive, ambition, but also with enough experience, contact network around us to really make the most of it. So we keep it pretty lean. We run very efficiently, and we have from the beginning of the company. And I think the outset is make sure that we give ourselves the best platform to really grow a royalty company. Looking on to the next slide here, just to give you an overview of our capital structure. We have about 69 million shares outstanding, and that gives us a US dollar market cap of 138, approximately 76 million US. We have about 5-6 million US in cash, and we have a $25 million credit facility currently with Sprott Lending, and that's really the capital structure. So it's pretty clean. There are no warrants outstanding. The only options or performance rights that have been issued are to the management and employees of the company. So we've never had to issue a warrant in a financing. I think if you look at our shareholder base, the top 20 shareholders hold about 70% of the company. So really quite tightly held on that front, and some large institutional shareholders as part of the company. In terms of target prices, we're covered by Canaccord, Hayward, and recently Laurentian, and that's anywhere from $2 to $2.60. And I think we're trading today at about $1.30. In terms of moving on from here, overview of the portfolio. Now, this is a really important slide. I think because what it highlights is how diversified we are already, both by country and by operator. So we're keeping that gold focus. So we're over 90% gold weighted. And I think we have managed to build Elemental from a standing start into a royalty company that frankly has some of the highest weighting towards producing assets in the space, let alone in the sub-billion dollar space. And I think that when you look at the quality of our portfolio, I think that really stands out. Endeavour, top 10 gold miner globally. Wahgnion produced 175,000 ounces last year. So that is a really good quality, long life asset, 1,000 square kilometer license package. And we have a 1% royalty on it for the life of mine. Capricorn's Karlawinda in Australia that just came into commercial production, a very successful, well-known team behind it there with Mark Clark and Kim Massey. And they brought that mine in on time, on budget. And I think that is going to be another long life plus 10-year reserve life cornerstone asset for Elemental going forwards. Alongside those, we have a mix of other producing royalties, Amancar in Chile, Equinox Gold Mercedes in Mexico, which starts paying us from July next year, and Base Resources Kwale in Kenya. So the reason this is so important, and frankly, the reason we set up a royalty company in the beginning was we can be as diversified or more as a mid-tier miner, but we are a 100 million market cap royalty company. And for us, we know that we can scale the company up. We have done that, and I'll jump back to this slide really to illustrate it. We have done it all the way since we started. $1 million fundraise in 2017 when we started the company, all the way through to next year, which should be sort of 10 million US plus. I think we have shown that you can scale the company up as you grow. If we can do that with diversified revenue base, with top line revenue, so we avoid inflation and costs, but we give investors growing exposure to gold revenue, and particularly the gold price, alongside all the optionality you get on these royalties. I think that is a really good way to build a long-term company for the future. And I think the reason we have a very mature institutional shareholder base is a reflection of that approach. We haven't gone out and bought 40 exploration royalties. We see an awful lot. We have really stuck to 9 good quality royalties that we chose individually, that we like, and where we've been able to, I think, to really to maximize value. Coming on to one of our biggest royalties. This is Endeavour Mining's Wahgnion. Endeavour, top 10 gold miner globally. This mine started in late 2019, and the royalty we acquired at the start of 2020. And this is one of our cornerstone assets. I think what's really encouraging for us is that Endeavour announced a $12 million US exploration budget this year. So I think most of the work in the second half of this year, and they actually announced target to increase the resources here by 1.5 to 2 million ounces by the end of 2025. To put that into perspective, they are planning to mine approximately 750,000 ounces over that same period to the end of 2025. So I think by the end of 2025, we might be close to being repaid on the acquisition cost of the royalty, and this mine should have more resources at it than when we bought it. And that is a beauty of the royalty model. We're getting continuing exposure to it in perpetuity going forwards. And when you have a really world-class operator like Endeavour, I think you maximize that success. This royalty on Karlawinda, this is our biggest royalty going forwards, and really, really important for us. It will pay us about $4.5 million US a year at current gold prices. And I think what's so encouraging about it is that they managed to build the mine on time, on budget, despite COVID, and then they hit commercial production within 3 months of first gold pour. So I think that's one of the smoothest ramp-ups in Australia in recent times. It's a management team in Australia that command a premium because of their track record, taking Regis Resources from $40 million company to over $2 billion. And I'm really pleased to have exposure to this asset and the management team going forwards. This has, as well as a plus 10-year reserve life, I think it's at the start of its life, like Wahgnion. So there is an awful lot of exploration exploration opportunity and potential ahead of it. And if you look at most mines around the world, you might see mines that start with a 10-year mine life, and 10 years later, they still have a 10-year mine life. So to have Karlawinda and Wahgnion, both at the start of their lives, both with 10-year plus mine lives based around reserves, really, really sets us up for the future going forwards. One of our other royalties that's been a material contributor in the last couple of years is Aminkaya. This mine originally came from Yamana Gold. The operator is Austral, and this is it's essentially a brownfields deposit near their existing mine. So again, I think really importantly, this is an operating asset, and for us, it gives us a lot of exposure to exploration success. So this is a 2.25% royalty. So this is the highest exposure we have proportionately. So any exploration success they have here is really meaningful for us. And this is a vein system, and so what you get here is you typically get continuing mine life as you mine, as you develop, as you explore. And I think that the operator Austral have said publicly that they will have a resource and reserve update coming out in Q1 next year. So again, really encouraging for us to see them starting to put money into the ground in terms of exploration, looking to extend the mine life. And of course, as a royalty holder, we don't pay anything for that. And we announced in Q3 that we were fully repaid on this royalty acquisition post-tax. So I think that's a really good position to be in going forwards already. The Mercedes mine, this is an exciting one for us. The royalty actually starts to, although the mine's been operating for over 5 years, the royalty starts to pay us from July 2022. So this is part of our growth coming in from middle of next year onwards. And Mercedes, it's a 1 million ounce resource. It's a 700 square kilometer license package in Sonora in Mexico. So a number of operations around it. I think a lot of exploration that can be done with a focused operator, and really looking forward to start receiving royalty revenue from this going forwards. Some of our other royalties here, we actually have a mineral sands royalty. We syndicated with one of the private equity funds in Kenya. It's a very good operator, Base Resources, excellent track record of production. And again, this is a royalty that we were fully repaid on, I think in 2020. Mount Pleasant in Australia, it's an over 1 million ounce resource based on previous disclosures. But what's really encouraging for us is the operator there, Zijin. So it's one of China's largest operators, $42 billion market cap. They have been working on the underground development of Tuat, one of the royalty areas. And I should say here that this is a mine in Western Australia that's been going for over 20 years, and it has about a 10 million ounce resource base, and our royalty covers approximately 1.5 million ounces of that. So it will come in and out of our royalty area, but they have been developing into one of the royalty areas over the last 6 months. So actually going forwards, that should start to be a contributor to us as well going forwards. A few other royalties in here. I think probably the one I would really just dwell on is Laverton, where we have a 2% gross revenue royalty, and this is in Australia. Focus Minerals is 49% owned by Shandong, again a very major Chinese company. It is listed in Australia, the actual Australian company. But what's really encouraging here is both it's in the sort of proximity to two existing mines. And I think what's exciting is not just the short-term oxide potential, which is easy for them to truck and either mine through some of the mills, process through some of the mills, or restart the Beasley Creek mine themselves. But I think longer term, what's really exciting is the Lancefield underground deposit. And in the 1990s in Australia, that was one of the top 10 underground gold mines. And it has not had any exploration work done on it in the last 20 years. So I think for us to have that optionality, to have the royalty over that, I think is really encouraging, particularly when you look at where Australian dollar gold prices have gone. So that's something that we really don't get much value for. But in the future, going forwards, I think could be really material for us. This is a slide I think it's really important to emphasize, not specifically even for Elemental, but for anyone looking at a royalty company. What you are getting is optionality on future discoveries. And what we want to do is we want to get royalties over really good projects with good operators where we can see lots of exploration upside. And we know that our revenue is going from 6 million, call it, to 10 million next year. So we know that we're getting really good cash flow. We know that our two cornerstone assets have 10-year mine lives based just on the reserves. But what we want to know is what's the potential here? How big can they get? What's the exploration upside? And we've taken a few things just to highlight here. But at Carla Winder, the mine I mentioned that's just come on stream, commercial production in October. If you look in the top right there, you can see the pit shell. And that is what the initial 10, 12-year reserve life is based off. And the interpreted mineralized zone, which is the red on that map, they actually had a government-funded drill hole about 1 kilometer away. And you can see they hit like 30 meters at 1.4 grams. So they're pretty confident that the mineralized zone continues. And when you look at the exploration upside there, it's really encouraging to see that this is a brand new mine at the start of its life, and there is so much still to do over the coming years in terms of exploration around it. And that is exactly what we as a royalty holder want to see, because we never have to pay for any of that. So I think really encouraging. At Wang Yon, as I mentioned earlier, Endeavour bought Teranga, the operator, earlier this year. So really the first update we've had recently on exploration from them was really encouraging. They're spending 12 million this year. I think they're spending about 36 million US up to the end of 2025 on the mine. So I think we're going to start seeing some really good progress being made at exploration there. And of course, that is directly relevant to us because every 100,000 ounces they mine at Wang Yon, we have a 1% royalty on. And so every time they add to the resource base, that is revenue that we will be getting going forwards that we don't have to pay for. And that is the great benefit of the royalty model. And these two royalties in particular, Wang Yon and Mercedes, district scale license packages. So these are assets where I think you could comfortably be exploring for many, many, many years. And they will still be finding new discoveries and new prospects and new targets. So I think really key to have some of those in the portfolio right from the outset. This is a highlight of, I think, both some of the operators, but also portfolio by NAV, and a breakdown of some of our key assets in there. I'll go through some of these last slides relatively quickly so we can go on to Q&A and go through some questions. But in terms of where we are on a valuation perspective, I think really encouragingly, for where we sit today, we are trading at 7 times price to revenue for 2022. And as I said at the beginning, this is not revenue from development projects. This is not revenue from mines that are under construction currently. That is revenue from existing operations. So mines that are up and running, commercial production, where either the royalty starts paying us next year, or in the case of Karlawinda, where the mine has just having its first full quarter of production now. So I think really encouraging to see where we're trading in terms of valuation and what the upside is. For us, that's really a key, I think a key factor going into 2022 is how our revenue grows, and with it, our free cash flow. In terms of share price, I think, again, this is, we've tried to sort of outline here our revenue and up until, I think, sort of this year, a lot of that is sort of actual revenue that's been announced. But you can see that as our revenue is growing, particularly coming into next year, so really starts to kick in this quarter, Q4 2021, you can see that actually our share price and our valuation have lagged the revenue growth. And I think that's where a lot of the opportunity is for us, because we are, I think for a sub $500 million royalty company, we are absolutely unique in the portfolio we have and the quality of the portfolio and the producing royalties within it. And when you look at 80% of our NAV is on producing assets, that compares with the Franco-Nevadas of the world and 1 or 2 of the major royalty companies. And so to get that in a junior royalty company that has demonstrated track record of adding value, that has grown the company from really a start. We weren't a spin out from another company. We weren't given a portfolio. We have built this step by step. And I think we're in a better position today than we've ever been, both in terms of our revenue, access to capital. Our portfolio is higher quality and more diversified than ever before. We're really starting to see some exploration upside. And I think the last transaction we did was a good example of that. We acquired a portfolio, it closed earlier this year, of 3 royalties from South 32, who are the spin out from BHP Billiton, the world's largest mining company. And they actually took 19% of Elemental and became our largest shareholder as part of it. And Simon Collins joined the board. And I think that is a real testament to the quality of the asset and also the upside that they as a major could see in our portfolio going forwards. So I think we're really excited about what we can do over the next year with Carl Lewin and Mercedes starting to come on. And I think we're in a really good place to take advantage of it. So with that, I'll hand back the presentation to Mark and look forward to answering any questions.
Terrific. Fred, thank you for a great tour through the company, look ahead at trajectory, and certainly a full set of context regarding players, the board, management, et cetera. Very, very healthy to get a good inside view at the company. I appreciate that very much. I know our audiences as well, because the Q&A column is quite populated. So we're going to jump right in here. Jacques asks, Fred, can you provide any update or progress on the initiative to refinance your credit facility?
So yes, I can. I will actually just jump back a few slides really to give some context here. But as I mentioned in part in the presentation, we have about $6 million US in cash, and we have a $25 million US credit facility that we took out when we made the South 32 royalty acquisition of the portfolio. And that is a facility with Sprott lending where we pay 9 plus 1%. And I think one of the key initiatives with the South 32 portfolio, and particularly Carl Lewin coming online recently, is to refinance that credit facility. And I think we have said publicly before that the trigger for that really was Carl Lewin coming into commercial production. So unfortunately, can't say anything else on that front until something is announced.
Yes.
But we're, from a company's perspective, we're very confident that we can put in place a better priced facility moving forwards. And that's really important for us because there is no sub $500 million royalty company that has borrowing facilities with some of the major banks. And so if we can get a borrowing facility, instead of 9 plus 1%, around the 5% mark, that is a huge competitive advantage, huge cost of capital advantage. It frees up cash from the interest. So that is a major, I think, action item for us. And since Carl Lewin has come into commercial production in October, I think that's something that we're looking forward to progressing and hopefully being in a position to say something publicly in the near future.
Terrific, Fred. Thank you for the insight there. Appreciate that. Moving on, a question comes in: is the royalty space very competitive in Africa and Australia?
Good question. It's actually funny. It's funny how these things work. But I mentioned earlier that the majority of the team are based in London. One of our directors and Richard are based in Australia, and the other directors are based in Canada. So we are a really diversified team as well as a portfolio. It has its benefits. It also has some disadvantages in terms of sleeping patterns and social life. But when you look at our portfolio, particularly now that we're listed in Canada, one of the things that stands out is we have more royalties really in Australia, Africa, and South America than we do in North America. And I think that has partly been opportunistic. I think it is also partly based on where our backgrounds were and where we've worked. And I've worked in Australia, I've worked in Ghana before. And so some of these opportunities came through contacts and network. So directly on the question, I do think there are more opportunities sometimes in emerging mining regions. And I think that's partly because a lot of the royalty companies, almost all of them historically, have been North American, US or Canadian based. And so I think that familiarity with the mining sector and the space, and even mining companies in North America, they are much more attuned and understand the royalty and streaming model better than they do in, say, in Australia. I think over time that will change. So I think at the moment, actually, the question's really on point, because I think there are some more opportunities in I would add South America, parts of Africa and Australia, and as well as that, I mean, we do want to add some assets in North America too. So I think going forwards, particularly as a Canadian listed company, I think it's very helpful for us to have some assets here too.
Very good. Thank you for that, Fred. As CEO, Fred, what's the key focus for you at the moment? Acquiring more royalty companies or acquire royalties?
So we haven't acquired any royalty companies, so it's definitely acquiring royalties. And I think that we've had a very, very busy year in terms of the opportunities we have looked at. Sometimes those opportunities take time to come through to completion. And we have had the sort of joke internally is that sometimes it's a royalty you sort of look at 2 years ago that pops up 2 years later and you do a deal on it in a month. Sometimes you find a royalty and a month later you're doing a deal on it. So it really does depend on negotiations, pricing, counterparties.
Yeah.
But we are really focused on new royalty opportunities. And I think we've had some people joining the team both on a full-time basis, but also on a technical side recently, helping us on a few of the opportunities where there's material amounts of DD that we need to do on a technical level in particular. So I think that's a key focus for us. And over the last 6 months, our portfolio has been materially de-risked. With our biggest royalty coming on stream successfully. And I think that unlocks an ability for us to go out now and do a few deals, where before I think we were being quite cautious in wanting to de-risk step by step as we go.
Very good. That's very clear. Thank you, Fred. The $1 million question, of course, what about dividends, Fred?
So we actually, unusually, because we were private for a few years before we listed, we actually have a longer history as a private company than we do as a public company. We did pay a dividend as a private company. So we paid 5% of royalty revenue as a dividend from day one. And we actually stopped that when we listed, because I think the key focus then was critical mass and scale. Yes. And when you're a listed company, you always have higher operating costs. And I think the important thing for institutional investors is really getting it to size and scale. And if we are able to, for example, reduce our borrowing costs going into next year, going forwards, credit facilities, taking it from order of magnitude 10% to 5%. If we're able with Carla Winder and Amin Kaya, Carla Winder and Premier's Mercedes, former Premier's Mercedes, starting to pay us next year, then I think we're in a much better position to look at starting to pay a dividend again. And when I say again, it's really again in the history of the company, but the first time as a public company. So I think 2022 is probably when that conversation starts to raise its head internally.
Very good. Thank you for that. Next question comes from David here, Fred. Are you all about precious metals or some base metals as well?
So our portfolio at the moment is 90. It's about 95% gold, silver, and the rest is really mineral sands and a bit of PGM.
Okay.
So we have guided historically that we'd be looked to be about 80% precious metals. So we have some flexibility, some headroom there to go outside of the gold space. I think we definitely want to stay 80% plus gold. But within that, we have looked at royalties in other commodities, such as copper, for example. And we obviously have one producing in mineral sands already. So I think keeping that gold weighting for sure, but being open to opportunistic acquisitions when we see them.
Okay, very good. Thank you for that. Next question comes up. What does it take to secure a royalty, Fred? Cash, shares, credit guarantee? It seems to be a more competitive field lately, no?
That's actually a really good question. And thank you for that, whoever asked that. And the reason I say that is when we have in the past transacted on opportunities, and some of that was when the royalty space, there were less companies. It was actually, 2-3 years ago, there were a lot less royalty companies there, particularly in the junior space when we started. But one of the key criteria counterparties had is, can you successfully execute on this deal? And for that, they wanted to know, do you have the money? is it guaranteed, or and if we're taking equity, how does that work? And I think that is one of the key differentiators we will have going forwards, and we have already used twice. When we bought the Wang Yuan royalty, we used a credit facility that we repaid after about 7 months. And when we did the South 32 deal, which both of those deals doubled the size of the company when we did it, we were able to use credit facilities again. And what that meant is we could deal with large counterparties. And so if you look at the history of our transactions, the Base Resources Quale royalty came from Acacia before it went back into Barrick Gold. The Mercedes and Amankaya royalties came from Yamana Gold. The South 32 portfolio at the time, they were probably a $10 billion market cap. So we have been able to deal successfully and execute successfully with both the mid-tier billion plus, but also the $10 billion plus companies. And I think that is a function of both our ability to access credit facilities, which most junior royalty companies can't do. Yes. I think it's an ability to use equity, because our portfolio is 80% producing royalties. Yes. So it's a very de-risked portfolio. And also, I think importantly, having some really supportive large institutional shareholders who have backed us to grow the company. And I think having them as well enables us to raise equity when we need it to do some of these deals. Right. So that's a really important component that I think people overlook. Finding a royalty opportunity is one thing. The next question is, can you actually execute on it? And we have done that successfully on multiple occasions on producing assets and across 5 different countries.
Very good. I hear balance and strategy there, Fred. Thank you for that. Great insight. Paul asked the next question, which is, how can you compete against bigger royalty companies, Fred, for new deals?
I think that actually the answer to that is try not to. And I think historically, if you look across our royalties that we have in the portfolio, most of those were not competitive scenarios. Most of those were individual opportunities where we approached the royalty holder and we negotiated directly with them, and we closed the transaction outside of a competitive process. And I think that's important for 2 reasons. Obviously, there's price competitiveness, but also secondly, as a small management team and a small company, we have limited bandwidth. Okay. And the last thing you want to do is spend all the time working on 10 different offers, and all 10 of them don't come to anything. So we try and be really selective on opportunities where we see them and where we invest our time, because our time ultimately, there's a real opportunity cost to it. And to grow the portfolio and to put in new assets, we need to identify things where we think there's a real prospect that we will successfully be able to come to terms and then execute on it.
Very good. Thank you for that. David asked the next question here, Fred. Have you written your own royalty contracts, or do you buy previous contracts?
So all the royalties to date actually have been existing third-party royalties. So it's a benefit there in that you're not reinventing the wheel and you're inheriting the agreements. What you do have to be careful with on third-party royalties is the terms, because you can't essentially rewrite those. And I think we're fortunate in that a few of the royalties had actually had the royalty agreements updated prior to us acquiring them. 1 or 2 were drafted recently by some of the big Canadian law firms. So they are very similar to how you draft it today. And then again, also a couple of the royalties we've acquired were already paying. So if there were any ambiguities in the agreement, they had already come through. But it's definitely looking at third-party royalty agreements. It's an area that has stopped us doing 1 or 2 deals because we have found flaws in the agreements, or we've found risks that we weren't comfortable with. And I think going forwards, there's definitely the potential for us to be writing new royalties or streams as well, directly with the operators. And that's very dependent on market conditions.
Very good. Thank you for that. We often like to go to that bird's eye view, Fred, and just to look at the 30,000 feet view here. What could you say might go wrong with royalty companies in general? What are some of the concerns and potholes to watch out for?
Okay, well, probably good to stick on this slide. I think commodity, it's a big risk. What is your outlook on gold? because clearly we have a revenue base that is pretty directly correlated with gold. So if gold goes up by 10%, the revenue that we get every month, every quarter, goes up roughly by 10%. Of course, the operators then discover more ounces, they mine more ounces, and we end up getting a lot of value add from that. But first of all, it's commodity price. So everyone has exposure to that. Second, I think, second biggest risk that always, when we were starting this company, kept me awake at night was individual asset risk. And there was a really good example in last year in 2020 when COVID hit.
Yes.
And for example, one of our operators, they had to reduce their workforce by 25%. They had to reduce some of their production because of COVID restrictions in country. And for them, that was, I think, really ate into their profit margins. For us, that was one royalty that essentially we still get the same revenue for it. It's just revenue deferred. And I think that has been one of the reasons we have focused so hard on producing royalties from the outset.
Okay.
We want, I'll jump back to this slide as an example, but if you look at our, we call it potential near-term revenue because we haven't put out official guidance. But if you look at that revenue chart already, before we add in any new royalties, you will see that we're diversified across a number of different assets. And those are all different operators. And they're actually all different countries too.
Okay.
So that is key because if you go to your mid-tier miner, 2 billion market cap, they might have 3 different mines, but they might have them all in one jurisdiction or one country or one place.
Right.
If we're spread across multiple operators, multiple countries, multiple jurisdictions, we take away a lot of that asset level risk and we reduce it down. And that's been the key. So I think, commodity risk number one, and then asset risk is number 2 for I think a royalty company.
Good to hear that. Thank you. One of my favorite questions, Fred, and I'm mindful of the time as we approach closer to the top of the hour here. For investors watching today, what would you say are some of the key road markers in the next 12, 18 months that we should be watching for as we watch Elemental Royalties?
I think this quarter will be a fun one because it will be the first full quarter of production from Karlawinda, our biggest royalty. So I think that's a great one to have. I think that also from July next year, getting revenue from Mercedes, and we've owned that royalty since 2018, but only starting to pay us from July next year. So I think inaugural revenue from Mercedes, first full quarter of production from Karlawinda this quarter, and then one that one of your questions touched on, which was credit facility.
Yes.
And again, I think for a 100 million market cap company, for us to be getting credit facilities with the bigger banks, I think that would be a real catalyst because that is a real line in the sand between us and peers.
Understood.
And I think what you get with an Elemental is you get royalties that would comfortably sit in the portfolio of a mid-tier or some of the majors. And I think that is what differentiates us from a lot of our peers, where they might have 50 or 100 exploration development royalties.
Yes.
They certainly don't have that producing cash flowing base. And that is what I think the hardest part of the royalty space is, the most competitive part. And I think we've been able to do it really successfully from the outset. And I think now going forwards, we can start to add in and strengthen on our pipeline.
Excellent, Fred. Thank you very much. As we get closer to wrapping up our session here, I always like to leave the door open for our guests. Is there anything we haven't touched on, Fred, or anything new that's come to mind to share with our audience today?
One thing I would just maybe highlight is I think people always underestimate the optionality on a producing mine. And the reason I say that is because once you have done the hard part in the mining business of financing a mine, permitting it, feasibility study, pre-feasibility study, construction, commissioning, once you have got through that, you are then incentivized to mine every ounce you can find in the region because that sunk capital cost is already there.
Yes.
And I think that is why, particularly from the outset, we liked producing royalties and the focus on it.
Yes.
Because we see the exploration optionality there as really high. Any ounces they find have a very high likelihood of being mined and paying us. And I think that is a key differentiator that investors often overlook. It's relatively easy to go out and find a 1 million ounce project. The risk is that project might still be there in 10 years. And I think for us, we're the other way around. I think we've got some really good quality assets paying us today, paying us for the next decade at least. And I think there's a lot of exploration that will come from it. And I think that's something I'd always say for investors. If you're looking at a royalty company, have a look at a couple of the key assets, have a look at revenue profile, and I think start from there.
Great wisdom, Fred. Thank you very much. You've filled a wonderful 3/4 of an hour with a terrific tour through the company, insights and perspective from your angle. I appreciate that. I know our audience has been very engaged. I will say thank you for your time, and we'll look forward to watching Elemental Royalties moving forward. I wish you all the best for the holidays.
Much appreciate it, Mark. Thank you.
Thanks, Fred. And for the rest of our group here online, just a reminder that the survey comes up next and you'll be rerouted at the top of the hour. We have Origin Royalties coming next as our guest company. We'll look forward to seeing you then. Thanks very much.